I guess it's been a minute, Mike. I'm already stumbling all over the place. Hello, everyone. We are very excited to have you here. Before we get started, I do need to go over a couple housekeeping items. And once I finish that, Mike will jump on and we'll get started here. So let's see if I remember how to do an intro on these webinars or not. So first and foremost, if you are here for CPE credit, we do need you to do a couple of things in order to receive that CPE credit. You will need to answer the poll questions as they pop up on your screen. If you have any issues with that, just send me a message. I'll help you get that sorted out, and we will go from there. You also will need to fill out the survey at the end of this webinar. It will pop up for you automatically as you're exiting, and it will be emailed to you in 24 hours. So if you'd like CPE credit, make sure you get that survey filled out one way or another. A couple other important things here. As we're going along, if you have questions, please reach out and ask those questions. You can use that Q&A button in the middle of your screen. If you just wiggle your mouse around, you'll be able to see it. You can ask those at any time, and we are going to do our best to answer them at the end of this webinar. So use that Q&A button, ask your questions, and we're going to do our best to address them. We also are going to be sending out the slides after the webinar, but I'm also going to upload them to the chat feature, and they're already uploaded to Zoom. So there are a few ways for you to get your hands on the slides and the handouts. And again, if you have any issues with that, just let me know. I'll help you get it sorted out. A couple of other things. If you love our webinars, if you don't want to wait a full week to listen to our next webinar, if you need to watch it in the middle of the night, we do have an option that allows you to still get CPE credit in our Salt Vault. You can purchase those webinars one-off. You can have a membership to our Salt Vault, which is an excellent resource for all kinds of educational information. There's state-by-state registration walkthroughs. There's an entire list. This is only part of it on the slide. So check out our website to learn more. Reach out to me and utilize those if it fits your needs. And let's at last do a couple introductions here. First, for Sales Tax and More. Sales Tax and More is a full-service consulting and solutions firm. We have a great team here of experienced tax professionals who are very dedicated to fulfilling your estate tax and related needs. So we do a lot of sales tax returns, sales tax registrations, consultations, research, and like our name states, more. So if you have questions or you'd like to work with us, please reach out. We'd love to hear from you, and we'd love to work with you as well. And a quick introduction for our founder, Michael Fleming. Mike's state tax knowledge is very well-rounded, and he's helped thousands of companies of all sizes in all industries, and is especially well known for his work in the e-commerce industry. And Mike, with that, please take it from here. Please relieve me of this pain of stumbling all over the place, and let's get started.
Not bad for first time back in a while. So great job, Ellie. Thank you for that wonderful introduction. Welcome, everyone. Thank you for joining us today. We have a lot of information to cover. We're going to start off with a quick definition of nexus. We're going to go over some nexus court cases that have to do with nexus. We're going to talk about economic nexus. We're going to talk about some current trends. Then we're going to talk about physical nexus, because even though this is about e-commerce, I find that some of the biggest problems for companies that are selling over the internet is their physical nexus. They're paying a lot of attention to economic nexus, not so much attention to the physical nexus. We're going to talk about marketplace collections. We're going to talk about deregistrations. We're going to touch slightly on income tax. We're going to talk a little bit about my view of the future, and then we're going to talk about how to register and some registration myths, time permitting. So a lot going on. Before we get started, Ellie, why don't we do our first poll question?
Absolutely. And that question should be up on everyone's screen right now. Quick reminder, you do have to answer these poll questions in order to receive CPE credit. And the question we have here is, how would you rate your Nexus knowledge? So Mike, it looks like we have a lot of people all over the place here. No absolute beginners so far. There's still time. A lot of people who fall somewhere in the middle, and even an expert in the crowd today. So why don't we close this out and we can move forward?
All right. Good to have some experts in the webinar today. Keep me honest. And as we say, the worst time to find out that you have problems or that your clients have problems is when you're being contacted by a state. And the reason why that's the worst time is there are programs out there to help mitigate past exposure, but you generally have to be proactive. You have to do it before a state reaches out to you. A lot of these programs, like a voluntary disclosure agreement, in most states, there's always the exception to a rule. um, in most states, if they reach out to you, whether it be by telephone or whether it be by snail mail or by email, or you get a Nexus questionnaire, it's too late. These mitigation programs are often off the table. So that's why it's the worst time to find out is when when you've been contacted by a state already. So you want to be proactive, especially if you have any past exposure. So quick definition of nexus. It's just a fancy word. It means link or connection. And when we're talking about taxes, it's the link or connection that must be present before state can require you to do anything like collect its taxes or pay its taxes, like an income tax, a franchise tax, a use tax. And, we have seller's use tax too. So that would be collecting. You collect the seller's use tax. You don't pay it out of your own funds generally. All right. So two primary types of nexus for sales and use tax. We have physical nexus. That's the traditional nexus. There are different types of physical nexus. Some are obvious, some are not. Some are very common and some are less so. When we say common, just about all states, if not all states, look at them the same way. Some are uncommon. States are going to look at them widely differently. And some are, like we said, obvious. Some are not so obvious. Then there's economic nexus, which is the newer nexus. This is where you don't have to have a physical presence or a physical connection. The thresholds can be based solely on revenue and or transactions. And different thresholds and different effective dates for each state. What's included in those thresholds is different from each state. We're going to get into that as we go through. But we want to say that it all starts with Nexus, because if you don't have this link connection that we call Nexus, the state can't require you to do anything. So no Nexus equals no problems and no responsibility. Ellie, why don't we go to our next poll question?
Yes, absolutely. So, quick little quiz for everyone paying attention here. Choose the best definition of nexus. So, quick reminder, you do have to answer these poll questions again in order to receive CPE. Your choices are a link or connection with a state that must be present before a state can require you to collect its taxes, um, working as a state employee and having to pay state income tax, a link or connection with a company and paying them taxes, or working as an employee and filling out sales tax returns. So, Mike, most people have got this right on the nose. Why don't we give everyone a couple more seconds and then we can close it out and move forward?
All right. And the correct answer is the first choice there, a link or connection with a state that must be present. That is the correct answer. All right. So moving on, let's look at some court cases. These are the cases that I think are very important to our discussion today. The first one is National Geographic versus the Board of Equalization, and these are all going to be U.S. Supreme Court cases. This is a 1977 case, and the Board of Equalization is California. The takeaway from this case is the taxable activity does not have to be related to the nexus creating activity. And what this simply means is that once an entity has nexus, the entire entity has nexus. It doesn't matter what business channel you're selling through. Now, this has become more and more important since the pandemic. And what we saw that a lot of companies that were selling to brick and mortar locations, a lot of distributors, a lot of wholesalers, were seeing that the brick and mortar locations didn't do very well, but the online companies were doing very well. So a lot of these traditional wholesale companies or distributors decided to go directly to the public, and they're selling online at this point to the end consumer. And they're thinking, well, I'm just starting out, so I haven't crossed any thresholds and I don't have to worry about anything until I start crossing thresholds. And unfortunately, that's just not the truth, because their wholesale operations, maybe they have independent sales reps, maybe they have manufacturing reps, maybe they have independent contractors, maybe they have plain old salespeople all across the country. And excuse me, they incorrectly are saying that, well, that's my wholesale operations. These are my retail operations. And it doesn't work that way. Once an entity has Nexus, it has Nexus for all business channels. So in theory, they should be collecting tax from day number one on all of these online sales. So it's becoming a bigger and bigger issue. We're seeing a lot of companies get tripped up by this. The next case is complete auto transit. Whenever we're talking about e-commerce, we get a lot of people, especially Amazon sellers, that say, well, the states don't have the right to tax interstate commerce. Only Congress can tax interstate commerce. And, if you go back to the 1930s when the first modern day sales taxes came into being, you'd be absolutely right, because even the states back then didn't think that they could tax interstate commerce directly. But that started changing in the 1950s. And by 1977, there had been a number of cases about this. We have complete auto transit, and the takeaway here is that the Supreme Court said that, yes, a state can tax interstate commerce as long as it meets a four-prong test, and it's a pretty easy four-prong test. Illinois seems to have run afoul of it. We're going to talk about that, but overall, pretty easy test to meet. So is it discriminatory? That's what we're going to talk about when it comes to item number 3 there, when we talk about Illinois. Yes, states can tax interstate commerce at this point. All right, next 2 cases. These cases have to do with physical presence, and they are perhaps the reasons I see companies getting in trouble. Since I've been doing this, these are the biggest reasons that trip companies up. The first one is Scripto v. Carson, Scripto, Georgia Pen Company. And Carson is the state of Florida. The state of Florida said, hey, these 10 independent contractors that you have in the state of Florida, we think that's creating enough of a significant presence that you should be collecting and paying our taxes. And Scripta said, you're out of your mind. These are true independent contractors, arm's length. We don't have any control over them. They can't be creating nexus for us. Well, it goes to the Supreme Court, and unfortunately, the Supreme Court sided with the state of Florida. And they said it's constitutionally insignificant as to what you call these people or how you pay them. They're doing the same job as salespeople would do. So yes, this can be nexus creating. And this is the beginning of what some people call attributional nexus. Some people call it agency nexus. I try to keep it simple. I call it third-party nexus. So third parties can actually create nexus for you. And that sort of defies common sense a little bit. I mean, when we're thinking of the activities that we do that could create a nexus footprint, we don't think of the activities that people are doing for us very often. So that's why this is, a major issue, because it just doesn't pop into front of mind what for a lot of companies and even their advisors when they're thinking where they may have potential exposure. Now, this was revisited in 1987. We have Tyler Pipe, that's a Texas company, and the state of Washington said, hey, according to Scripto, you should be, paying our business and occupation tax. And Tyler Pipe said, oh, no, this is not like Scripto at all. I said, these people don't represent us exclusively. There's only one person. They're not very good at their job. They hardly send us any business. It's like having a part-time person. And they represent multiple parties. And it goes to the Supreme Court. And the Supreme Court came back. And the first part of this, I'm going to paraphrase. The second part is extremely important. So what the court said is that, it doesn't matter what you call someone, doesn't matter what you pay them, doesn't matter if they represent you exclusively or if they represent multiple parties, doesn't matter if they do this on a full-time or part-time basis. Here's what's important. Are they helping you to establish or maintain a market? And if they're helping you to establish or maintain a market, then that can be nexus creating. And the reason why that establish or maintain a market language is so important is because many of the states took that language and incorporated it directly into their statutes or their rules, their regulations, or they use it to provide guidance. The state courts use it as precedent. What better case to use than a U.S. Supreme Court case for precedent? So very, very important language, establish or maintain a market. We're going to talk about this a little bit more, but again, I can't emphasize how important looking at the activities of third parties, because in all the time I've been doing it, this is the greatest issue that shows up time and time and time again, because it just doesn't make common sense. All right, then we have South Dakota versus Wayfair. It's the reason many of us are here now, and this overturned the Quill case and National Bellis Hess. These are the two previous cases that had to do with physical presence. So in theory, states could have went back to 1967. That's when we had Bellis Hess. And it's important to note that the states didn't say, hey, times have changed. And, we need to change with the times. The state said, and this was rare when they said this, we made a mistake. We never should have introduced the concept of physical presence to begin with. We were wrong. We inadvertently created a protected class of, sellers out there, and that was not our intention whatsoever. So this ushered in what we call economic nexus. And an economic nexus simply means that this link or connection doesn't need any physical piece connected to it. It can be based solely on sales, can be based on transactions, or a combination of the two. Now, what makes this so tough is that the states look at this very differently. Some states include non-taxable sales. Some states include sales through a marketplace like Amazon. Some states don't. We've got a chart that I'm going to show you next that really gets into what you're going to need to know on this. But before we get to that, I want to talk about the protection. Here we are. This was back in June of 2018. So we're in 24. So we just had the 6th-year anniversary. We're going on 7 years now. And I still hear people talking to our salespeople or giving me a call and saying, well, Mike, I want to deregister in the state of Texas, or I want to deregister in the state of California. And I'll ask them, how come? And they'll say, well, I'm underneath the $500,000 threshold. And neither state has transaction thresholds. So I want to go ahead and deregister at this point. And invariably, if it's a client, I'll say, well, last time we spoke, you had an independent contractor that was traveling into the state of Texas. Oh, yeah, I still have that, but I'm underneath the threshold. Or in California, well, last time we spoke, you had inventory in an Amazon warehouse. Oh, yeah, I still have that, but I'm underneath the $500,000 threshold. And I have to let them know that, unfortunately, economic nexus doesn't protect you from any other type of nexus. As a matter of fact, a physical nexus is going to trump an economic nexus when it comes to sales tax in almost all scenarios. I can't think of a scenario where it doesn't trump it when we're talking about sales tax. Income tax, not so much. Sales tax, the physical presence is almost always going to trump an economic nexus. So this doesn't protect you. It doesn't override any other type of nexus. It's just one more way for the states to get you to do what they want you to do, which is collect and or pay their taxes. So 8 years, excuse me, over 6 years into this, and we still have this misconception out there. Also, this is a big misconception, and this happens. Our salespeople talk to a lot of CPAs out there, and number one, we hear, well, I don't have any clients that are subject to this internet tax. Well, tax and nexus are two entirely different concepts. I was on the phone with someone the other day. They kept telling me the nexus tax. Two entirely different concepts. Nexus just is a link or connection, where if you have this link or connection, you may have to collect tax, but it's not a tax in and of itself. And it's not an internet issue either. Economic nexus, you don't have to have a website even. You can be selling entirely by telephone. You can be selling entirely by referral, by infomercial, by catalog. You may not sell on the internet at all. This is a multi-state issue. So if you or your clients are selling into multiple states, then this could be have an impact on you. So multi-state issue, not an internet issue. Now, another thing, and I'm surprised, it's so many years past the pandemic when someone comes to me and they say, well, our clients are not selling online, so we're not impacted by this. Well, we just talked about why that's not correct. But so many clients are selling online now. The world has changed since 2018. So we have to be asking our clients, hey, are you selling online? Simple question. When you're doing an annual review with these clients, make sure that you're inserting that into your list of questions. You'd be surprised at how many people don't realize, how many CPAs or accountants don't realize that their clients are actually selling online and could have exposure in a lot more states than they originally thought. All right, so here is that chart I was talking about. And by the way, every software company out there, even some of the platforms like Shopify, are going to tell you, well, we'll automatically tell you where you need to be registered. And unfortunately, if you're just listening to these software companies, you're generally going to end up getting registered in too many states. Once in a while, not enough states, because these systems just don't get granular enough in order to correctly predict how many states. So the software is a great red flag. It's going to alert you to a potential issue, but you don't want to run out and get registered everywhere. I can give you example after example. When someone came to me and said, well, Mike, I need to get registered in 25 states. Well, how come? Well, so-and-so told me, or, the software told me, or Shopify told me. Say, okay, well, let's talk through this. And after all said and done, they're getting registered maybe 5 states, because each state is different, and you have to look at your specific fact pattern to see if you fit. For example, in the middle of the page here, what states say to include or exclude from the remote seller's threshold? So some states say just retail sales. Some states say gross sales. Some states say sales through a marketplace. Sales for resale are included in some states. They're excluded in other states. Exempt sales. So a lot of people say, well, this is exempt. It shouldn't be included in the threshold. Well, a number of states do include it. Some states say, well, we'll exclude sales for resale, but all other exempt sales are going to be included. So most of this information is not captured. Even maybe you're not putting your Amazon sales into Shopify. So that would be a case where you're being underreported and maybe not registering in enough states. But more and more um, companies get registered in too many states. So great red flag. Once you get this red flag, go back, pull out a chart like this. This is going to be a handout. It's also, we keep it updated on our website. And you can go through each of the state and look at your fact pattern, or you can contact someone like us. We have a service. We call it a data review. We look at your data for economic nexus. It's relatively inexpensive service. It's $795, and we'll tell you where and how to register in each one of these states. When I say how, do you want to take care of any of the past exposure? Do you just want to register prospectively going forward? That's the how. So great chart. If you have past exposure, it will tell you what the thresholds are historically. It'll tell you what the period is. Some say previous calendar year, like Alabama up there. That's a fairly easy state. Every December or January, you got to look at the preceding calendar year. And if you're over the threshold, then you maybe need to get registered. If you're not over the threshold, you don't worry about anything until the following December or January. So fairly easy. State like Illinois, they have a rolling 12-month period, and they say you need to check it every quarter. So that's a little bit harder. The ones that are the hardest, or can be the hardest, are the ones that say previous or current calendar year. So you got to be looking, every January, every December. But if your company's growing very quickly, or your client's company is growing very quickly, then you might have to check it more frequently during the year. If it's just growing at a normal pace, then again, you don't have to check it as often. You just check it at the end of the year. But I'll give you an example. We had one client who was on Shark Tank, and this is a couple of years ago now. And I looked at their previous year's sales, and they were a small company. We were doing the sales tax returns, and they were registered in like 3 or 4 states. And, when I did their data review, I looked at it and said, okay, you need to get registered in another 2 or 3 states. And at that point, the salesperson stepped in and said, Mike, no. And this is, by the way, the month of March. So it was fairly early in the year. They said they were on Shark Tank and their sales are exploding. So when they gave me 3 months worth of sales for the year to date, I added like another 18 states that they were over the threshold. So the quicker your company is growing, the more frequently you want to check this. You don't want to start building liability. So just a couple of quick notes about that. Here's a couple more. Prospective enforcement. South Dakota was smart because the Supreme Court was worried if they, overturned these 2 previous cases, National Bill Hess and Quill, that the states might try to go back all the way to the 60s. And South Dakota, which was a state involved in the Wayfair case, said, no, we're going to just do this prospectively. In other words, going forward. But that's from the effective date. And we're 6 years into this. So the effective dates are getting old. And, nobody had any past exposure when this, passed in 2018, or when in the following years as more states passed it. But now these effective dates are getting old and the exposure is building, and it's getting quite large for many companies. So you don't want to procrastinate. There's a lot of reasons. There are 2 surveys out there. These surveys are getting a little bit dated, but from our own experience, about 50 to 60% of companies are not compliant for economic nexus. In other words, they're not doing it right. And the states are starting to get aggressive. So a number of companies, when they find out, they say, oh, I'm just going to register going forward. And in some states, they're not questioning that. But in other states, they are. South Carolina, South Dakota are questioning registrations. Arizona, Arkansas, Illinois, Wisconsin, and Maine are actually auditing registrants. They'll let you get registered, but 2 years later, 3 years later, they're going to come back and say, hey, when did you actually cross the nexus? Because we think that based on your sales that we're looking at, that you probably crossed it prior to the date that you told us. And Illinois is virtually auditing everyone. So when we're registering people with past exposure here, we're telling them you either got to do in these states, you've either got to do some sort of VDA or historical registration, something to take care of that past exposure. Because it's not a matter of if you get contacted in a number of these states, it's a matter of when you're going to get contacted. Other states are sending nice guy letters. That's when a state says, hey, you may be required to be collecting and remitting our taxes. They start out as nice guy letters. They get more aggressive as time goes on. Utah is starting to become a little bit more aggressive. So this is prospective enforcement, but it's prospective enforcement from the effective date that in each state. And those effective dates are on that chart that we just showed you. Now, here's a current trend. There's a trend away from transactions. And whenever I say this, people say, oh, we don't have to worry about transactions anymore. I didn't say that. I said there's a trend away from it. Roughly 35% of the states out there still have a transaction threshold, and there's some of the bigger and or more aggressive states. Illinois has a 200 transaction threshold. New Jersey has a 200 transaction threshold. So we still have to look at it on a state-by-state basis. But the states in that first group up there, they've eliminated them. They used to have a transaction threshold. They got rid of theirs. The ones in the second group, they've never had a transaction threshold. And then you have Connecticut, New York. All these other states that do have transaction thresholds use the word or. So it's $100,000 or 200 transactions. But Connecticut and New York use the word and. So they don't have any standalone transaction thresholds. Connecticut is $100,000 and 200 transactions. New York is $500,000 and 100 transactions. So there's a trend away from transactions. This is a good trend. A lot of companies find that they can deregister because they only got registered because they were over the transaction threshold. So it's definitely a positive trend, but you can't ignore transactions. And when you deregister is important. Some states make this retroactive and you can deregister right away. Other states say, nope, you got to wait a year because we got trailing nexus. So an example would be Idaho. I believe they came out and they said you got to wait until January of 2025 before you can actually go out and, excuse me, Iowa, not Idaho, before you can go out and get re-registered, deregistered, where Indiana said you can do it right away. All right, so Florida imposed economic nexus and marketplace facilitator status. These are some of the states that were late to the party. Florida and Kansas both became effective on July 1st of 2021. Florida, $100,000, no transactions. Kansas, $100,000, no transactions. The difference between these two states is the look-back period. Florida says just the previous calendar year. Kansas says previous calendar year or the current calendar year. And then Missouri, also $100,000, no transactions, but they did not become effective until January 1st of 2023. After the fact means that these are the states that have changed things after the initial round of information came out. So this is part of the update, even though that some of this is old. Some of you may know about these changes already, others may not. So Wyoming dropped the transaction threshold. That was just this past July 1st. So Indiana dropped the transaction threshold on 1/1/24. So that was one that they actually backdated. South Dakota dropped the transaction threshold. in 2023. South Dakota, by the way, they were the state that started this all, and they thought $100,000 or 200 transactions was fair. And then they came out and dropped their transaction threshold. So here's a list of the other states. Now, Alaska, I want to talk about. A lot of people say, well, Alaska is one of the nomad states. Nomad states are the states with no sales tax. Well, Alaska doesn't have a state sales tax, but they have local sales taxes to different boroughs and municipalities. And they formed what's called the Alaska Municipal League, and that enforces and collects the taxes in Alaska. And the majority of these local, not all, but the majority of these local jurisdictions have joined the Alaska Municipal League. And if you're over $100,000 or 200 transactions, you've got a responsibility to collect and remit potential responsibility to collect and remit taxes in Alaska. And Alaska taxes a lot of items and services. Pennsylvania, they were sending notices to those with inventory in Pennsylvania, specifically Amazon inventory. Pennsylvania said they're going to continue to be aggressive, but court ruled against Pennsylvania. They said having inventory in an Amazon warehouse is not enough to create nexus for other business channels. At least for sales tax. For income tax, Pennsylvania is still saying that it does create nexus. Most states still say that inventory at an Amazon warehouse still create nexus. California, very, very aggressive. Some states have changed, like the state of Texas. State of Texas says that if that inventory is only used to fulfill Amazon sales, doesn't create nexus. But if you use it to fulfill the Shopify sales, it does create nexus. Illinois, very similar. Arizona, they say that if you ship it to Arizona, then it creates nexus. If Amazon moves it to Arizona, then it doesn't create nexus. But most states out there have not changed since prior to Wayfair and Amazon having to collect the taxes. Now, I said that Illinois was running afoul of the four-pronged test. In Illinois, pretty confusing. You've got the retailer's occupation tax and you've got a retailer's use tax. The retailer's occupation tax is their sales tax. Retailer's use tax is a vendor's use tax. So remote sellers with no physical presence must collect destination-based retailer's occupation tax. And there's almost 4,000 different jurisdictions in Illinois. So you got to worry, we had to hire a team of extra people to handle the returns that we do for our clients in Illinois because it's that much extra work. There's it's a real pain. So if you have a physical location where you're shipping things from, in other words, a warehouse in Illinois, then you use the retailer's occupation tax, but you use origin. So you only have to worry about one rate and one jurisdiction. It's a lot easier to do that. So, we talked about, one of the prongs being discriminatory. A tax can't discriminate against interstate commerce. Well, to me, this is, out and out pure discrimination. If I'm outside the state with no connection to the state, I got a lot more work to do. I got to figure out rates in 4,000 jurisdictions. I got to, figure out how to correctly file the returns in those 4,000 jurisdictions versus, someone who's in the state, one jurisdiction. Someone finally, I've been talking about this since they implemented this pretty much, but someone finally is taking them to task, and we'll see how that turns out. I tell people, even though I think this is a violation of the Constitution, the fixes are too easy and fixes can be done retroactively. So you might as well continue to collect at this point. I think that it's the safer bet. Now, we were telling clients about a workaround. The retailer's use tax. If you had a physical nexus, say, for example, you had a salesperson traveling into Illinois, Well, you're subject to the retailer's use tax. And the retailer's use tax, you don't collect the local jurisdictions, you only collect the state rate. So that was a loophole. We were telling people who were remote sellers to, hey, send a salesperson in there, create some physical nexus, and now you don't have to worry about these 4,000 jurisdictions. So if you're doing the returns yourself, that's a heck of a lot easier. Or, if you're working with us, then you just have to worry about getting the rates correct in those 4,000 jurisdictions. So the workaround was send a salesperson, create a physical nexus, and you don't have to worry about the local. Illinois is closing that loophole. They're not fixing what we believe to be unconstitutional, but they are closing this loophole. As of January 1st of 2025, you'll need to collect the destination-based retailer's occupation tax if you have a physical nexus. All right, so Illinois, by the way, aggressively enforcing and they're auditing everybody for the start dates. All right, so Colorado retail delivery fees. Colorado started this trend by imposing 6 different fees. When they started, they totaled 27 cents. And the fee is imposed on any transaction with at least one item of taxable, tangible personal property delivered in the state by a motor vehicle, and it's retail only. And this went into effect in 2022. It's designed to generate funding for environmental and infrastructure projects. Now, the problem was this originally applied to all sellers, no matter how big they were, and it had to be collected from the customers. You could not pay it on behalf of the customers, and it created a huge problem because a lot of software, they couldn't get this set up to collect it. So they revised it a year later, July 1st of 2023. They said this only applies to sellers with sales in Colorado in excess of $500,000 or more, and the sellers can now pay on behalf of their customers. So it is a separate registration, it is a separate return, but they made it a lot better. In the 2023, the fee went to 28 cents, and it just went to 29 cents on July 1st of this year. So these retail delivery fees, we think we're going to be seeing more of them. Minnesota played copycat. Their fee became effective on July 1st, imposed on any transaction with at least one item of tangible personal property delivered in the state by a motor vehicle, retail only. It applies to sellers with greater than $1 million of sales in Minnesota, and the fee is 50 cents, and the sellers have the option to collect from the customers or pay it themselves. Now, a lot of exemptions in Minnesota. So food ingredients, prepared foods, drugs and medical devices, baby products. So a whole bunch of exemptions. This is a little bit more complicated than Colorado. But it's just one more way for the states to raise revenue. All right, so not every threshold is economic nexus. We've got what we call cookie nexus, we've got click-through or affiliate nexus, and we've got notice and reporting requirements. So cookie nexus, the state of Massachusetts views this as a physical presence. Cookie nexus is when a company installs data packets on in-state computers and then uses the information from those data packets, maybe to market towards those customers. Massachusetts, there were other states with this. When economic nexus came around, most of the states backed away. Massachusetts did not. The effective date is pretty old. At this point, it's almost 7 years old. So and Massachusetts has lost this in the courts numerous times, but they are still actively enforcing it. So it's something that you need to look out for. Going forward, I think this is going to be a much bigger issue when it comes to income tax nexus. The Multi-State Tax Commission has changed their guidance on what constitutes protected activities, and cookies will invalidate the protections of Public Law 86272. But that's another webinar, or we'll touch on it briefly later on. Cookie Nexus. For sales tax, the only state you really have to worry about it is in Massachusetts, and only if you have some great past exposure. Once their economic nexus kicked in, they did sunset this. So it's just that period between October 2017 and when their economic nexus passed. Click-through nexus, if we go back, the state of New York said, hey, if one independent contractor in Tyler Pipe could create nexus, well, how about a whole state of people, sending business to someone and getting paid commissions or referral fees? Is that not the same thing? And this went to the highest court in New York, and the highest court agreed with revenue in New York. It never went to the U.S. Supreme Court. So at its height, 21 states followed New York here. And there were thresholds. Thresholds were anywhere between 5,000 and 500,000. And once you cross the threshold in sales from these types of relationships, then you were supposed to collect and pay tax. By the way, one thing I saw the software companies doing is they're saying pay-per-click is a type of click-through nexus. And although the word click is in both, pay-per-click was specifically excluded from most of the states out there that had this click-through nexus. You were paying for specific performance. Something had to be sold. And pay-per-click advertising, nothing is being it may not be sold. So that was the big difference there. All right, so use tax notice and reporting requirements. This is perhaps the worst thing that I have ever seen states do. And the U.S. Supreme Court let them get away with it. And this was started by Colorado back in 2010. Colorado wanted some of this online revenue. There were no Amazon warehouses in Colorado at the time. So Colorado said, you know what? We can't make you collect our tax, but we can make your life extremely miserable if you don't volunteer to collect our tax. So that was the theory behind this. And we thought Colorado was out of their minds. This spent 7 years in the courts. Went to the U.S. Supreme Court twice. The first time, the Supreme Court said this is not a tax, so they sent it back to the lower court. And at that point, Judge Gorsuch, it was before he was a Supreme Court justice, said that Colorado could move forward. And the Direct Marketing Association immediately appealed it to the U.S. Supreme Court, who decided not to hear it again. So you had a lot of states move forward with it at that point. So what this is if you're not collecting tax and you're not required to collect tax, you've got to provide your customers with a series of 3 or 4 notices, depending on the state. And what these notices basically say is that the seller is not collecting the tax, so the purchaser must pay the tax directly to the state themselves. And oh, by the way, some states made you say this. Other states didn't make you say it. They still made you do it. They just didn't make you tell your clients. They had to turn over a list of their clients to the state at the end of the year so the state could follow up with them to make sure that all of these people were paying their taxes directly to the state. So this was a marketing nightmare. I mean, what customers were hearing is, hey, you're not doing your job, so you're making me do a lot more work, and you're narking on me. You're turning me over to the states. How can you do this? So it was a PR nightmare for these companies. But it gets worse, because if you didn't comply, it turns out Colorado was kind of, the same one when it came to this. Their thresholds excuse me, their penalties were not that bad. You had other states like Oklahoma. They've got a $10,000 threshold, and their penalty is 20% of the preceding year's revenue, or $20,000, whichever is less. So on $10,000, 20% of that is $2,000. But here's the kicker: it's per instance. So if you need to do 3 or 4 notices, let's say there's 3 notices in Oklahoma, that's $6,000 per transaction. And how many transactions did it take you to get to $10,000? I mean, with just $10,000 in sales, you could potentially have a 7-figure penalty. And for the first 5 years, the legislature said that the Department of Revenue had the ability to mitigate those penalties, but after the 5 years, their hands were tied. We haven't seen the state go after anyone, but it's still hanging out there. So they haven't repealed it or anything else. So Oklahoma, something, even though their economic nexus is $100,000, you got to pay attention if you're over $10,000 in taxable sales. Vermont and Puerto Rico, no thresholds. Vermont, $25 for the penalties. Who cares? Puerto Rico, though, while not as bad as Oklahoma, you could have 4 sales in Puerto Rico, total, $5 each, and you could owe upwards of, $2,000. So, you've got 4 sales in Puerto Rico, just stop selling there. It's not worth it. If you've got a lot of sales in Puerto Rico, then you're going to want to be registered and make sure that you're taking care of the sales tax. Louisiana, $50,000, no transaction threshold there. $50,000 in revenue. So most states that had this, some of the worst, which were the state of Washington, the state of Pennsylvania, they sunset this when economic passed. But these list here, Vermont, Puerto Rico, Oklahoma, and Louisiana, they still have it. So when you're figuring your exposure, you got to take that into account. Here is a chart that we have. I think this is in the process of being updated as to which states you got to worry about, which states had it, which states never enforced it, which states did enforce it, but it's sunset. So we'll let you know when that is updated. So here's some developing trends. Number of states, but not all, we've talked about these already, are moving away from the transaction threshold. Some, but not all, states are eliminating affiliate or click-through nexus as they implement their economic nexus. And some states are limiting notice and reporting requirements, but you still have to look out for Louisiana, Oklahoma, Puerto Rico, and to a much lesser degree, Vermont. Ellie, we want to do the next polling question?
Absolutely. We have a quick true or false question for everyone here. True or false, you must have physical presence to create Nexus. The answer, I guess, sorry, getting ahead of myself here. Quick reminder, you do have to answer these poll questions in order to receive CPE credit. If you can't see the poll question right now, please shoot me a message and we'll get that sorted out for you. And a quick reminder for everyone, if you have questions as we're going along, use that Q&A feature. We're going to do our best to address them at the end of this webinar. And Mike, why don't we move forward and I'll close this out in just a minute.
Okay. So third-party nexus. We talked about this early on. I said this is something that a lot of companies and their advisors get wrong because it just doesn't make common sense. When we're thinking about the activities that we do that can create a link or connection, we just don't usually think of third parties, how they can be creating these links or connections for us. And this is a list of activities. It's not an all-inclusive list, but it's an example of the types of activities that fall under this umbrella language of helping to establish or maintain a market. What we usually tell our clients is if you have someone going into a state who's going to be interacting with the public on your behalf or interacting with your clients on your behalf, and that's generally could be a nexus creating activity. But it's not all third-party relationships. Let's say you hire a software developer on a 1099 basis, and they're not interacting with the public usually. They're not, interacting with your clients usually. So that's not going to be a nexus creating activity. Or you hire a bookkeeper on a 1099 basis. Again, not going to be a nexus creating activity. So it's not all third-party relationships. It's just those that help you to establish or maintain a market. So travel, it's not just where your employees or contractors live, but anywhere they travel on your behalf. And this trips up companies too. I mean, if your accounting department is the one who's responsible for keeping you compliant, they often don't know where people are traveling. Where are the salespeople? With the contractors, the independent contractors, you still have to be helping to establish or maintain a market. But for employees, it's pretty much anything. There are some carve outs when they're in there buying, and there's some trade shows are treated a little bit differently. But states like Michigan and Arizona, they say if you're there for greater than 48 hours throughout the course of the year, cumulatively, then that can be nexus creating. So very low thresholds. All right, so inventory, we talked about how that creates a physical presence in most states, whether the inventory is consigned or whether it's in a third-party warehouse or an Amazon warehouse. We talked about Arizona, Illinois, Pennsylvania, and Texas for sales and use tax. Here's one, related entities. So if third parties can create nexus, how much easier is it for a related entity to create nexus, especially if they're performing services for one or another, and or they're not being run as totally separate companies? I mean, if you're sharing assets, then that's often enough to create nexus. Some states even say if you have similar names and are selling similar items, then that's enough to create nexus. This is our wholesale and this is our retail. So we didn't want to create nexus for the retail. So we created a separate company for the wholesale. But if you're selling similar items and have similar names, then that will often still create nexus. This is a big one, ownership of rental or rental of tangible personal property. So if you lease or rent to others, you still have an ownership interest in that. And if it goes across a state line, then now you own property in that other state. And that is very common that the state is going to say that's enough to create a link or connection with the state. Where you have employees' locations or where you live or operate your business from. And this is something I get a lot. Mike, I do everything in the cloud. I don't have this link or connection that you talk about. And unfortunately, the states don't look at that way. Where you live or where you operate your business from is creating a link or connection. So that's number one. Number two, during the pandemic, a lot of people had to work from home, and a lot of the states suspended their, nexus for remote employees. That's all expired. All of that's behind us, and states are going after companies who have not registered and have still allowed their employees to work from home. So big issue here. Now, this is a handout. It's also up on our website. These are the 10 common nexus creating activities for sales and use tax. When we say common, these are looked at, if not all states, the majority of the states as nexus creating. And that's in direct contrast to the 12 state specific nexus creating activities. States look at these very different. Sometimes only one state will say that this is going to be nexus creating. Usually it's 5 or 6 states. This you have to go through. And like trade shows, states look at that widely different. Some states try to say that, hey, if you even come here as a consumer, we could consider that nexus. I think the state would be hard pressed uh, to make that stick. I've never seen it done, but they still say it. But if you're an exhibitor, a lot of states say, hey, if you exhibit here, that's the same as soliciting. Other states draw a distinction. You can be an exhibitor, but you can't actively solicit. Other states say, hey, you can be an exhibitor and you can actively solicit so long as you don't make any deliveries or take any money while you're here. And then you've got states like, or not states, but you've got Nevada, who they want everyone to come to Las Vegas. They say you can do all of the above as much as you want, except for the taking of the money and delivering of the property while you're at a show. If you do that, you need to collect the sales tax. You don't need to be registered if you're only doing that one time a year. You just need to give the sales tax to the show promoter, or when you get home, mail it into the state. You do that twice a year. That is nexus creating. So, oh, and by the way, when it comes to trade shows, everyone talks about de minimis language, and states are notorious for not spelling out what de minimis language is. Trade shows is one of those areas where it's different. Some states actually have very good de minimis language when it comes to trade shows. So a lot of it has to do with the number of days spent there. A lot of it has to do with the number of days and or the amount of business generated. So widely different on a state by state basis. All right, let's talk about some case studies. And this first one here, this is an old case. This is when Amazon had probably 7 or 8 warehouses. And this gentleman here, he was an early adopter. He registered everywhere Amazon had a warehouse. Now, he lived in Missouri. Missouri did not have a warehouse, so he didn't get registered in his home state. Now, one of the ways that states find companies is they go to the IRS and they say, please give me a list of everyone who's got a 1099 in my state. And then they compare that with who's issued the 1099 and compare that to what other taxes they're registered for in the state. So it's a way that states find companies. So this one here, they saw that the 1099 was issued from Amazon, and they went after him. And that's when he contacted us, and he told us the facts, and he said, well, I have a virtual office. I don't have any location. So can you make the argument for me that, I don't have Nexus? And unfortunately, we told them we didn't think that was going to work, but we'd make the argument. We went to the state laughed at us. And so we had to go back to them and said, unfortunately, not everything that you're selling is taxable, so we can help you there. And we helped them get the numbers down that the state was looking for. But he was pretty much dead to rights there. So, this is a great example of how states find you, as well as, the virtual office just doesn't fly. All right, here's another case study. This is a camera leasing company, and they leased high-grade camera equipment like you use for filming movies or commercials. And the state of Massachusetts found them, said that they had nexus due to owning tangible personal property in the state. And they had audited one of their customers, and they saw that, this transaction. And the company said, well, we can't be doing it wrong. Everybody in our industry does it this way. And Massachusetts said, get us a list of everyone in the industry, and we'll go after them also. We got a call from one of their competitors. That's how we found out about this, because Massachusetts did contact them. This guy said, can you believe my competitor turned me in? And unfortunately, yeah, we can believe it. It happens more frequently than you believe. We helped them out. Not everything they were doing was taxable. And they had problems all across the country, so we got them compliant across the country. But this is brings up another point here. You won't believe how many times I hear, well, so-and-so doesn't do it this way, and they're a huge company, so they must be doing it correctly, or there's safety in numbers. No one's doing it this way. Those are famous last words. Here in the state of Texas, just about everybody gets website design and website hosting wrong. So those types of companies are routinely targeted because they know that companies are not getting it correct. And, big companies, sometimes they're the worst people to follow. Big companies often have people who are dinosaurs. They've been around for 20 years. They're set in their ways. They don't stay abreast of these changes. And if you're following them, then that's a big problem. So just because a company's big does not mean they're doing it correctly. Another case study, specialized software company. 30 years ago, this gentleman, the owner of the company, asked his fraternity brother, who happened to be a CPA, and said, hey, do I have to worry about, collecting tax? And the CPA said that Nexus was created by traveling salespeople. So don't let your people travel. You're going to be okay. And for 25 plus years, they had no problems until they were contacted by a state who said, we believe you had Nexus. Now, this company was located in the state of Oregon. State of Washington contacted them. There was no sales tax in Oregon, so they weren't even used to, how sales tax works. And when Washington contacted them, they said, hey, we audited one of your customers and we see that they're reimbursing you for travel and you're doing implementations, software, and that's going to be taxable in our state. And they said, oh, no, you got it wrong. None of our salespeople travel. They said, well, Nexus is not only salespeople traveling, you've got someone here. Well, some of these people were independent contractors. Well, just like we said before, third parties can create Nexus. So anyway, the state wanted 7 years of back tax plus penalty and interest, and it totaled over $500,000. And at that point, the company gave us a call, and they were terrified. They were in tears, basically, because they extrapolated this out, and it was over $15 million they were going to owe if all the states found them. So I had to talk them down off the cliff, let them know that, it's not going to be a problem. They thought they were going to be going to jail. I told them no one's going to jail. It's not like you collected tax and didn't remit it, which people do go to jail for. And that's becoming a bigger and bigger issue, companies collecting and not remitting the tax. But I digress. They were afraid they were going to go to jail for not collecting the tax. And I talked them down from that. And then they were saying, well, we might as well be in jail because we're going to be bankrupt as soon as we tell our bank they're going to pull all our credit lines, that we've got all this contingent liability out there. And we told them there is a path forward. And long story short, they asked me to get on the phone with their bank. And we talked to the bank, and the bank actually lent them more money. They had to do over 40 VDAs. And the problem with VDAs is you got to pay voluntary disclosure agreements. You still have to pay something, even though it's a great tool. And if you got to pay 40 states the last 3 to 4 years of back taxes plus interest, that's a huge number. Most companies do this 5 states at a time, 10 states at a time. They do it with the states with the greatest exposure. But the bank lent them more money. They did it all at one time. So when all was said and done, we got the number down from the over 15 million they were expecting to just about $1 million. I've never seen anyone so happy to pay $1 million. I mean, it was truly amazing. They were thanking us for helping them pay $1 million. But you got to remember where they were coming from. They truly thought they were going to jail. They truly thought they were going bankrupt. They truly thought they were going to have to be paying $15 million plus, and they were going to be going on their own. But the bank helped out. And so $1 million to them was a win. All right, so how do states find you? Auditing your customers, we talked about that. The camera leasing company, information sharing with other states or the IRS. We talked about getting 1099s from the IRS. Amazon tells them States request a list of companies that have inventory in the Amazon warehouse. Amazon gives it out. Web surfing, some states do it manually. Other states, like the state of Washington, have web crawlers that look for certain terms. Leads, former employees, some states actually pay bounties if you turn in your employer or anybody turns in a company and money is actually collected. So, disgruntled employees can get their pound of flesh and get paid for doing it. Competitors, we're seeing this more and more nowadays. Companies say, well, the reason I haven't gotten registered for economic nexus is none of my competitors do. I'm hearing footsteps. I want to do this, but I'm going to lose too much business. Is there any way I can turn in my competitors? And unfortunately, there's ways to do that. Customers usually inadvertently, or they can be disgruntled and turn you in. But you don't charge them tax. They call the state and say, hey, my vendor didn't charge me tax. Do I need to pay a use tax on this? And next thing you know, the state's saying, who's your vendor? And you're on a list. Some states purchase lead lists. The reason you don't want to be on a list is the discovery units out there whose primary function is to follow up on these leads. And they have other ways, but they're looking for taxpayers that are not registered who they think should be paying their tax. All right, Ellie, let's go to this poll question.
Absolutely. The question is, what about sales tax nexus concerns you the most? Quick reminder for everyone, you do have to answer these poll questions in order to receive CPE credit. Also, use that Q&A button in the middle of your screen if you wiggle your mouse around to ask any questions that we'll address at the end of this webinar. And Mike, we have answers all across the board here. A lot of people saying third parties and economic nexus. Why don't we move forward, and I'll leave this open a few more seconds while answers roll in.
Yeah, and those are the common answers. Economic nexus, because it's relatively new and it's constantly changing, and third parties, because it's not obvious. It's not even common sense. So those are the two most common answers we see. All right, so marketplace facilitators, these are sites like Amazon, eBay, Etsy, Walmart. They're not platforms. Shopify not currently considered. They're moving in that direction. BigCommerce, WooCommerce, these are not considered to be marketplace facilitators. And 46 states plus DC and Puerto Rico do have collection requirements. So sometimes you may actually be considered a marketplace facilitator, and we're seeing more and more of this. Some companies realize that they are. Other companies want to be a marketplace facilitator. They want to be a marketplace. So we're actually being contacted by more and more companies that want to know the requirements. If you're only selling on a marketplace, or sometimes even if you're selling on a marketplace, but your sales outside the marketplace are very limited, it's time to start talking about deregistrations. So there are some exceptions. Your home state, you generally want to stay registered there. State of Washington, depending on how big you are because of the business and occupation tax, Amazon doesn't pay that on your behalf. And then states like California, where you may need a resale certificate, there are some scenarios where you're going to want to stay registered. However, if you have limited sales or zero sales outside of a marketplace, deregistrations is what we want to be talking about. Now, some states eliminated transaction thresholds. We were talking about this earlier, but they still have a trailing nexus. So the previous periods, the old rules still apply. Various states retroactively make it effective back to day one. So it may not be in effect today, but when you get audited, it wasn't in effect 4 years ago. So they're going to use whatever was whatever the laws were at that time. So there are some warnings for deregistrations. A deregistration is a process, and it's going to vary between the states, and it's often a lot harder to deregister than it is to register. States are notorious for not doing what you tell them to do. So a lot of companies just turn off the tax. Other companies, after they deregister, forget to turn off the tax, and they're still collecting tax, and now they have no way to remit it. So here's some deregistration warnings. When we do a deregistration, we do three things. Number one, we let the state know what we're going to do. Number two, we do what the state wants us to do. And then number three, and this is the most important step, is follow up to make sure that the state has done it. So you can't just, file paperwork and expect it to be done. Some states are very, very efficient. Most states are not. And you definitely cannot just stop filing. We have companies that call us and say, hey, I don't have Nexus anymore, and this state is saying that I owe them, thousands of dollars. Well, have you filed your returns? No, I don't have Nexus anymore. Well, did you deregister? No, I'm still registered. Well, that's why. So you got to do this process to deregister, and you have to turn the tax off after deregistration. And by the way, income tax, totally separate from sales tax, has its own Nexus rules. So deregistering for sales tax will generally have no impact on your income tax requirements. Now, Hawaii is a little bit of a different bird out there. They have a general excise tax, and it's imposed on the seller. Now, it can be passed through to the customer. Most companies do that. However, if you're selling on Amazon, as the marketplace facilitator, is going to collect the retail rate from the customer, 4%. The marketplace seller is responsible for the wholesale rate of 0.5%, but the marketplace seller loses the ability to reimburse themselves. So most of our clients in this situation, it's such a small number. They have limited sales to Hawaii, and 0.5% is not a lot of sales. So they just don't worry about it. But if you're selling on Amazon, you have a lot of sales to Hawaii, this is something that you need to take into account. Marketplace collection, not all positive. Nexus still created in most states by the inventory. You need to collect tax for the other channels when you have the Nexus created by that inventory. States are still pursuing sellers for back tax plus penalty and interest, specifically California. You still have filing responsibilities. For example, the Washington Business and Occupation Tax. And this is a big one. States can easily access seller information, and income tax is going to be the next big battle. So leads us into this slide here. FBA sellers were the first target. California going after a lot of them. Pennsylvania followed them up. And they got their hands slapped for a sales tax, but they're still going after companies for income tax. This is not going to stop with FBA sellers. It's going to spread to all e-commerce sellers. And Public Law 86-272 says that if your only contact with the state is solicitation, then state is not allowed to impose a net income tax on you. This is a law passed by Congress in 1959. But Massachusetts says that in light of Wayfair, Public Law 86-272 is unconstitutional. The Multi-State Tax Commission sent out revised guidance, and states like New Jersey and California have already adopted it. New York is looking at it. Other states are looking at it. And cookies, which we talked about earlier, post-sale emails or post-sale chats, you got to do customer service. These things virtually eviscerate the protections of Public Law 86-272. You get a state like Oregon that created a new gross receipts tax because they believed, okay, if we can't get your income tax because of Public Law 86-272, we'll create a new tax and try to get some of that money there. So I think over the next 2 years, we've already seen this start, but this is going to become quite a nightmare over the next 2 years. It's going to be the next big battle for e-commerce sellers. Now, here's the revised unprotected activities. You can go through that. Pretty much the post-sale customer service. California, New Jersey have officially adopted. By the way, Hawaii didn't say they officially adopted this, but they no longer recognize the protections for companies with Nexus. So they just say, sorry, if you've got a significant Nexus, Public Law 86272 does not apply. And here's the most aggressive states out there. This is not an exhaustive list. Florida, if you're a C Corp, they've become very, very aggressive. If you're a pass-through entity, there's no personal income tax there. Why Nexus matters more than ever? Well, states geared up to track down sellers for economic Nexus, and then the pandemic happened. They put everything on hold. It's been accelerating again, and I think it's going to get ugly. Especially, as states need more money. During recessions, states need to make up revenue. And historically, they've increased their discovery efforts and their auditing efforts. So I think we have a perfect storm out there. Even if we're not technically in a recession, states are feeling the pinch, and they're increasing their discovery efforts, and they're increasing their auditing efforts. And while these states are looking for economic nexus because they see that as low-hanging fruit, they're going to stumble across all types of nexus. And while, someone may have had economic nexus for 6 years, which is bad, what happens if you had an independent contractor for the last 10 years or 12 years or 15 years? Now, states usually limit themselves from going back, but they still go back routinely 7, 8, or 10 years. And even though a state says we normally go back 7 years, I've seen Texas try to go back 12 years. So this is why Nexus matters more than ever right now. All right, so Ellie, why don't we open it up to questions at this point?
Sure. And you know what, Mike, first we're going to launch our 5th poll question and let people answer that really quick. Quick reminder, you do have to answer the poll questions in order to receive CPE credit. This is probably the trickiest quiz question that we've had today was, will you be joining us for upcoming webinars? We are about to head into our 7 Pillars series where we break down our webinar, that 7 pillars of a successful sales tax strategy, into individual pillars. So that's what we will be doing over the coming months. Please join us every week for that. It's great. It's a newer webinar series that we do. So we hope we see you there. And Mike, let's take a look at our questions.
All right, I see one here
ahead.
about Oklahoma.
Yeah, I'll read this one to you. So
All right.
my client, go ahead. Oh, my
Is that
client selling mainly in Shopify and Amazon received an alert from Shopify to register with Oklahoma. My client does use a fulfillment company located in Oklahoma. My client's annual sales are less than 10,000. Does my client need to register with Oklahoma for sales and income tax? The annual sales amount for Oklahoma is less than 1,000. Thank you.
All right, so let's answer this the way the state would answer this. The inventory in Oklahoma is generally going to be a physical nexus. And once you have a physical nexus, the state expects you to collect and remit their taxes. So Amazon is collecting the taxes for the Amazon sales, but the Shopify sales are what you would need to be collecting the tax on. Now, states think that once you have nexus, you need to collect the tax from dollar number one. I say we need to use some common sense. Just because a state says that you should do something doesn't necessarily mean it makes good business sense. So if you have taxable sales of $1,000, well, the tax would only be $80. And you add penalty and interest to that of $80, roughly 80. I'm using an average rate of 8%. That's $160. Well, you can't get registered for $160 and then file returns. Because once you're registered, you're going to have to file the returns, whether you're doing this yourself or whether you're hiring someone. I just don't see how you get that done. It doesn't make sense. You'd be better off waiting for the state to come and find you. Now, if your tax on the sales in Oklahoma are $1,000, that's a whole nother story. And you got to say, is that material to you? If the state finds you, they're going to want their $1,000 in back tax, and that number will continue to grow with time. Plus, they're going to want their penalty, and they're going to want their interest, which can quickly total greater than 50%. So that $1,000 turns into $1,500 multiplied by the number of years that you're not registered. So if that number is not material to you, if you get audited by the state and say, oh, no big deal, I'll just cut them a check, then a lot of companies would decide not to get registered. Other companies would say, oh no, $1,500 is a lot of money, and multiply that by 5 years, that's $7,500. That's really a lot of money. So I'm going to get registered. There is a cost to compliance, but the cost of not being compliant, if your exposure is material, is much greater than the cost of compliance. So it's all a matter of looking and saying, does this make sense? Do I want to protect myself? So that we say you got to use some common sense and determine what's material to you. State says you need to be registered and collecting and remitting the tax.
All right. Thank you so much, Mike. And anything else you want to follow up with here?
No, I just want to thank everyone for joining us today. I know this is the first webinar we've done in a while, and we're, knocking the rust off, and we will get better as we go forward each time we do it. So thanks for joining us today. I hope that you have learned something, and if you have any questions, just get them on over to us, and we'll see what we can do to answer them, and hope to see you on the next webinar. Bye-bye.